Walk down almost any British high street, any coastal promenade, any small town center, and you will find one. The fish and chip shop, battered cod or haddock, thick-cut chips, maybe a pickled egg or saveloy in the warmer, mushy peas behind the counter. And that unmistakable smell of hot oil and vinegar that has been a part of British life for well over a century. From the outside, a fish and chip shop looks like one of the most straightforward businesses imaginable. You buy fish, you buy potatoes, you batter and fry them, you sell them for more than they cost, and you go home at the end of the night. It looks simple. It looks traditional. It looks almost quaint compared to the slick tech startups and franchise chains that dominate modern business conversation. But the actual economics underneath that fryer are far more demanding, far more volatile, and far more instructive than the simplicity of the product would ever suggest, because a fish and chip shop is not really a simple takeaway. It is a tightly compressed food manufacturing and retail operation running on perishable raw materials, energy-intensive equipment, extremely narrow windows of peak demand, and margins that can shift dramatically based on forces the owner cannot control at all. If you enjoy breakdowns like this that explain how real businesses, real money, and real ownership actually work across Britain, follow Money Framework British now. Because this channel is built for exactly this kind of honest, detailed analysis. The first thing to understand about the economics of a fish and chip shop is the raw material cost, because unlike many takeaway or fast food businesses where the core ingredients are cheap, shelf-stable, and relatively predictable in price, a fish and chip shop's two most important inputs, fresh fish and potatoes, are both genuinely volatile commodities whose prices can move significantly based on factors entirely outside the shop owner's control. Fish prices depend on catch volumes, fishing quotas, fuel costs for trawlers, weather conditions at sea, seasonal availability, currency movements affecting imported fish, and global demand for the same species from other markets. A chippy owner buying cod or haddock is not buying a manufactured product with a stable factory price. They are buying a wild-caught protein whose wholesale cost can shift week to week, and whose supply can tighten suddenly if fishing conditions deteriorate or if quota restrictions change. Potatoes, while less dramatic in their price swings, are still an agricultural commodity affected by growing conditions, harvest quality, storage costs, and seasonal availability. A bad potato harvest does not just mean slightly smaller chips. It can mean meaningfully higher input costs across the entire trading year, applied to the single product that represents the bulk of what the shop actually sells. Now layer cooking oil on top of that. A fish and chip shop uses enormous quantities of frying oil, and the cost of that oil has become one of the most significant, most painful operating expenses in the sector. Vegetable oil and other frying oils are global commodities, and their prices have at various points surged dramatically due to supply chain disruptions, agricultural shortfalls, trade policy changes, and broader inflationary pressure. For a business that literally deep fries almost everything it sells, the cost of oil is not a minor line item. It is a core, recurring, high-volume expense that the owner faces every single day the shop is open, and that, like fish and potato prices, moves independently of anything happening inside the shop itself. Then comes energy. A fish and chip shop is one of the most energy-intensive small food businesses in Britain. The fryers, the ranges, the extraction systems, the lighting, the refrigeration, the hot holding equipment, all of it draws significant power. And energy costs for British businesses have risen sharply in recent years. A chippy cannot simply turn its fryers off during slow periods to save money. The equipment needs to be hot and ready when customers arrive, and peak demand windows are often compressed into a few intense hours. That means energy consumption runs high, even when the shop is not actively serving. And the cost per unit of energy consumed has, for many operators, become genuinely painful. Some owners have described energy bills that doubled or worse within a relatively short period. A cost increase that, in a business with already narrow margins, can be the difference between a viable operation and one that is slowly bleeding cash. This is where the margin reality needs to be understood clearly. A fish and chip shop looks like it should be profitable because the markup on individual items appears generous. A portion of chips costs relatively little in raw potato and oil terms, and the selling price is several times the ingredient cost. A piece of battered fish has a meaningful markup between wholesale fish cost and the price over the counter. But that apparent generosity is an illusion created by looking at gross ingredient margin alone and ignoring everything else the business has to pay for. Once you layer in oil, energy, rent, or mortgage on the premises, business rates, insurance, staff wages, employer national insurance contributions, pension auto-enrollment, equipment maintenance and eventual replacement, extraction and ventilation system servicing, waste disposal, cleaning, packaging, card processing fees, accounting, food safety compliance, and the owner's own drawings, the actual net margin. What the owner keeps after everything is paid is typically far thinner than the headline ingredient markup would suggest. And this is one of the central tensions of the fish and chip shop model. The product itself is perceived by customers as affordable, everyday traditional food. It is not luxury dining. It is not premium casual. It is chippy tea, that cultural positioning. While commercially valuable because it creates broad, reliable demand, also creates a genuine pricing ceiling. Customers have strong expectations about what fish and chips should cost. And those expectations are anchored in decades of the product being positioned as accessible, working-class, family-friendly food. An owner who raises prices to reflect genuine cost increases risks, losing customers to competitors, to supermarket alternatives, or simply to the feeling that the chippy has become too expensive for what it is. This means the business often absorbs cost increases rather than passing them fully through to the customer, which compresses margins further. That pricing tension is made worse by the competitive landscape. In most areas of Britain, a fish and chip shop is not the only hot food option available. It competes with pizza delivery, kebab shops, burger chains, Chinese and Indian takeaways, meal deal supermarket offers, home cooking driven by cost of living pressure, and an ever-growing range of delivery platform options. Each of these alternatives puts indirect pressure on the chippy's pricing and demand. If a family can feed 4 people more cheaply from a supermarket rotisserie chicken or a frozen pizza, the chippy loses that transaction not because the food is worse, but because the price comparison no longer works in its favor. This is why volume matters so much. A fish and chip shop needs to serve enough customers at a high enough average transaction value across enough trading days to generate sufficient total gross profit to cover its fixed and semi-fixed costs. If volume drops, the math deteriorates quickly because many of the costs, rent, rates, insurance, core staffing, energy standing charges, do not drop with it. If this kind of practical, honest business analysis is useful to you, follow Money Framework British, because the goal here is always to explain how the money really moves, not just how the business looks from the outside. Now consider the labor economics specifically. A fish and chip shop typically needs a fryer, which is the skilled role at the center of the operation, and at least 1 or 2 counter and preparation staff during busy periods. The fryer role is genuinely skilled. Knowing how to manage batter consistency, oil temperature, cooking times across different fish sizes, chip blanching and finishing, and the overall flow of orders during a busy Friday night rush is not something that can be learned in an afternoon. A good fryer is the engine of the operation, and replacing one is not trivial. Staff costs, including wages, employer national insurance, pension contributions, and any overtime or weekend premiums, represent a major portion of the shop's operating expense. For smaller shops, the owner often works as the fryer themselves, which keeps the wage bill down, but means the owner is physically standing over a hot fryer for hours every trading day. A level of personal physical commitment that is easy to underestimate from the outside. Staffing also creates a scaling problem. During peak hours, especially Friday and Saturday evenings, the shop may need its full team working flat out. During quieter periods, there may barely be enough trade to justify having anyone there at all. But you cannot simply send staff home and call them back when it gets busy. You need people prepping, cleaning, and maintaining readiness. This mismatch between peak demand staffing needs and quiet period reality is one of the structural inefficiencies baked into the model. It means the shop is often either slightly overstaffed for the quieter stretches or slightly understaffed during unexpected surges. Neither situation is ideal. Opening hours and trading patterns add another layer. A traditional chippy might open for a lunchtime service and then again for an evening service, with a closed period in between. That split shift pattern is operationally awkward. The shop incurs costs across a long day, but only earns meaningfully during compressed windows. Some shops stay open continuously through the afternoon. But if afternoon demand is weak, that extended opening just adds energy and staffing cost without proportionate revenue. The most profitable hours are almost always concentrated into a few peak periods each week. And the entire economic model depends on those peaks being strong enough to carry the rest. A bad Friday night, whether caused by weather, a local event pulling people elsewhere, or simply a quiet spell, can meaningfully dent the week's overall performance. Location is another critical factor. A fish and chip shop needs footfall, visibility, and accessibility. Coastal locations can benefit from tourist traffic, but that traffic is heavily seasonal, meaning the shop may do very well in summer and struggle through winter. A town center location may have more consistent year-round demand, but also higher rent and rates. A residential neighborhood location may have loyal regulars, but limited passing trade. Each location type creates a different revenue profile and a different cost structure. And what works brilliantly in one setting can fail in another. Rent itself is often the single largest fixed cost after staff. And in some locations, it has risen to levels that make the traditional chippy model extremely difficult to sustain. A landlord charging premium rent on a high street unit does not adjust that rent downward because fish prices went up or because Tuesday was quiet. Business rates compound this. Many small food businesses in Britain are liable for business rates on their premises, a tax that applies regardless of how the business is actually performing. Rate relief exists for some smaller properties, but plenty of fish and chip shops sit just above the threshold for meaningful relief, meaning they pay a significant annual rates bill on top of rent. This is another fixed cost that does not flex with trading performance. It simply has to be covered week after week, whether the shop is busy or not. Then there is the equipment itself. Commercial fryers, extraction systems, refrigeration units, and hot holding cabinets are expensive to buy, expensive to install, and expensive to maintain. A fryer does not last forever. Oil filtration systems need servicing. Extraction canopies and ductwork must be cleaned and maintained to comply with fire safety and environmental health standards. When a major piece of equipment fails, the repair or replacement cost can be substantial, and the shop may not be able to trade at all until it is fixed. This creates a capital maintenance requirement that is ongoing and unavoidable. The owner must either set aside reserves for equipment replacement or face the risk of an unexpected large expense arriving at exactly the wrong time. Regulatory compliance is not glamorous, but it is real. Food hygiene ratings, environmental health inspections, allergen labeling requirements, fire safety compliance, waste oil disposal regulations, packaging rules, and employment law all apply to a fish and chip shop just as they apply to any other food business. The difference is that a chippy often has fewer administrative resources to manage all of this. There is rarely a compliance department. The owner handles it, often alongside frying, ordering, staffing, and everything else. Falling below standards can result in a poor hygiene rating, which in the age of online visibility can damage trade quickly and persistently. Maintaining high standards takes time, effort, and sometimes money. And it is another cost that is invisible to the customer, but very real to the operator. Delivery platforms have introduced both opportunity and complication. Services that allow customers to order fish and chips for delivery can bring incremental revenue, especially from customers who might not otherwise visit the shop. But these platforms typically charge commission on each order, and that commission can be significant enough to erode or even eliminate the margin on lower value orders. A portion of chips ordered through a delivery app may generate almost no profit for the shop once the platform's cut is taken. The shop also loses control over the delivery experience, meaning late or poorly handled deliveries can result in complaints and negative reviews that the shop itself could not prevent. Some owners embrace delivery platforms as a necessary channel. Others view the commission structure as unsustainable and prefer to focus on walk-in trade and their own direct delivery if they offer it at all. There's also a generational and cultural challenge. The fish and chip shop has deep roots in British food culture, but eating habits are changing. Younger consumers may be more interested in diverse cuisines, health-conscious options, plant-based alternatives, or the kind of Instagram-friendly food presentation that a traditional chippy does not naturally provide. Some shops have adapted by introducing gluten-free batters, vegan options, sustainably sourced fish, or more modern branding. Others have stayed resolutely traditional. Neither approach is automatically right or wrong. But the shops that fail to acknowledge changing consumer expectations at all risk gradually losing relevance, especially in areas where the customer base is shifting demographically. Sustainability and sourcing have also become more prominent. Customers and advocacy groups increasingly ask where the fish comes from, whether it is sustainably caught, and what the shop's environmental practices are. Sourcing MSC-certified sustainable fish, for example, may cost more than alternatives, but it can also support premium positioning and customer trust. Managing waste oil responsibly, reducing single-use packaging, and minimizing food waste are all areas where a conscientious operator incurs cost, but may also build longer-term brand value. In a business where margins are tight, every additional cost needs to be justified. But ignoring these trends entirely carries its own commercial risk. One of the most interesting dynamics in this business is the relationship between perceived simplicity and actual operational intensity. From the customer's perspective, a fish and chip shop is about as simple as food gets. You walk in, you order, you wait a few minutes, you get hot food in paper. But from the owner's perspective, that simplicity is the product of constant, demanding operational management. The oil must be at the right temperature. The fish must be fresh. The batter must be consistent. The chips must be the right texture. The portions must be generous enough to satisfy, but controlled enough to protect margin. The queue must move fast during busy periods. The shop must be clean. The staff must be trained. the stock must be ordered accurately. The waste must be minimized. Every one of these small disciplines, executed repeatedly across thousands of portions per week, is what turns raw ingredients into a functioning business. Get several of them wrong consistently, and the shop declines. Get most of them right, and the business can be remarkably resilient. That resilience is real. Fish and chip shops have survived world wars, recessions, the rise of supermarkets, the explosion of fast food chains, the arrival of delivery apps, and dramatic shifts in British eating culture. The ones that endure tend to share common traits. They control costs ruthlessly without cutting quality. They build genuine local loyalty through consistency and friendliness. They maintain their premises and equipment properly. They adapt to changing customer expectations without abandoning the core product. And critically, they understand that the business is not really about frying fish. It is about managing a compressed, high-intensity food operation, where small efficiencies compound into viability and small inefficiencies compound into failure. So how does the money actually flow in simple terms? Revenue comes from over-the-counter sales and potentially delivery orders. From that revenue, the owner must cover fish, potatoes, oil, batter ingredients, other menu items, packaging, energy to run the fryers and the rest of the shop, rent, business rates, insurance, staff wages and associated employer costs, equipment maintenance, waste disposal, cleaning supplies, card processing fees, delivery platform commissions if applicable, regulatory compliance costs, accounting, and eventually equipment replacement. What remains after all of that is the owner's actual income. And for many operators, that income, while sufficient to support a livelihood, is nowhere near as generous as the queue out the door on a Friday night might suggest. The fish and chip shop therefore occupies a fascinating position in the British business landscape. It is culturally iconic, deeply familiar, and commercially demanding in equal measure. It rewards operators who combine physical stamina with sharp cost management, who understand that perishable inputs and compressed trading windows leave almost no room for waste, and who recognize that a business built on affordable, beloved food must fight constantly to protect margins that the customer never sees and rarely thinks about. It is not a business for anyone looking for passive income or a comfortable lifestyle venture. It is a business for someone willing to stand over a fryer, manage every penny of cost, build genuine local trust, and accept that the economics of putting battered fish and chips into someone's hands are considerably more complex than the comforting simplicity of the product itself. And that is perhaps the most important insight of all. The fish and chip shop endures not because the economics are easy, but because the people who run them well are extraordinarily good at making something genuinely difficult look effortless. The customer sees hot, delicious, affordable food served quickly. The owner sees oil prices, fish invoices, energy bills, staffing rotas, equipment wear, and a margin that needs protecting every single day. The gap between those two experiences is where the real economics of this business live. If you want more breakdowns like this into how British businesses, ownership, and everyday commercial life really work beneath the surface, follow Money Framework British and turn on notifications so you never miss the next